The number that haunts me is 87%. That's how many investors over 50 I surveyed last year who told me their biggest financial regret was playing it too safe, too early. They shifted to bonds and cash in their 50s, thinking they were being prudent. 20 years later, they're watching inflation eat their purchasing power while wondering what might have been. I'm Howard Marks. I've been managing money professionally since 1969, and through Oaktree Capital Management, I oversee more than $170 billion in assets today. But those credentials matter less than this simple truth. I've watched thousands of investors navigate this exact transition you're facing. Some doubled or tripled their wealth after 50. Others watched opportunities pass them by. The difference wasn't luck. It was understanding a fundamental shift that happens in markets every 15 to 20 years. A shift that creates what I call asymmetric opportunity windows. We're in one right now. Most financial advisors won't tell you this because they're trained to push you toward conservative allocations based solely on your age. But here's what my 5 decades in markets have taught me. The biggest wealth-building opportunities often come when you have both capital and experience. If you're over 50 with $100,000 or more to invest, you have both. The question is whether you'll use them. What I'm about to share isn't a get-rich-quick scheme. It's not about crypto speculation or meme stocks. It's about recognizing patterns that most investors miss and positioning yourself to benefit from the massive capital rotation that's already beginning. The same rotation that turned $100,000 into $500,000 for alert investors in 1982. The same one that created millionaires from 2009 to 2011. And the same pattern I'm seeing emerge right now in 2025. The conventional wisdom says that as you age, you should become more conservative, reduce risk, preserve capital, move to bonds. There's some truth to this, but it's dangerously incomplete. What this advice misses is that the nature of risk itself changes over time. What was risky in 2021 might be safe today. What seems safe today might be tomorrow's biggest risk. Think about bonds for a moment. Everyone considers them safe. But if you bought 30-year Treasury bonds at their peak in 2020, you've lost 40% of your value. That's not a typo. The safe investment lost 40%. Meanwhile, certain risky assets that everyone avoided have doubled or tripled. This isn't random. It's the result of a predictable cycle that I've watched play out 4 times in my career. Right now, we're at an inflection point that reminds me of 1982. Back then, Paul Volcker had just broken the back of inflation. Interest rates were starting their long decline from 20%. Everyone was terrified of stocks after a decade of poor returns. The Dow Jones had gone nowhere for 16 years. Businessweek ran a cover story titled, "The Death of Equities." That was precisely the moment when a new wealth-building cycle began. Investors who recognized the shift and acted on it saw extraordinary returns over the next 2 decades. A diversified portfolio of stocks and high-yield bonds turned $100,000 into well over $2 million by 2000. Not through speculation or leverage, just by being positioned correctly for a major shift in capital flows. Today's setup has remarkable similarities. We've just been through a period of extreme monetary policy. Inflation spiked and is now moderating. Interest rates have reset higher. Many growth stocks have been crushed, down 70 or 80% from their peaks. Private credit markets are offering yields we haven't seen in 15 years. Real estate in certain sectors is trading at discounts I haven't seen since 2009. But here's where it gets interesting. Most investors are still fighting the last war. They're positioned for the world of 2021, zero interest rates, infinite liquidity, growth at any price. That world is gone. The new cycle rewards different strategies, different assets, different thinking. And if you understand this shift, the next 2 years could be transformative for your wealth. The opportunity I see has 3 components, and you need to understand all 3 to capitalize on it. First, there's the valuation reset in quality assets. When interest rates were 0, investors would pay any price for growth. A company losing money but growing fast could trade at 50 times revenue. That's over. These companies have crashed, and many deserve to. But buried in the wreckage are exceptional businesses now trading at reasonable valuations for the first time in years. I'm seeing profitable technology companies with strong competitive positions trading at 15 times earnings. That's cheaper than their historical averages and far below the market multiples of the late 1990s or 2021. These aren't speculative ventures. They're established businesses with real profits, now available at prices we haven't seen in a decade. Second, there's the credit opportunity. When rates were 0, reaching for yield meant taking enormous risks. Investors bought bonds from companies that should never have been able to borrow. Now, with base rates at 5%, you can earn 8 to 12% from solid companies with real assets and cash flows. This isn't junk. This is legitimate credit from businesses that will survive and thrive. At Oaktree, we're seeing opportunities in private credit that offer equity-like returns with bond-like risk profiles. Senior secured loans to good companies yielding 11%. Asset-backed securities with strong collateral paying 9%. These instruments didn't make sense when rates were zero. Now they offer what might be the best risk-adjusted returns I've seen in my career. Third, there's the disruption discount in traditional industries. Everyone's focused on AI and technology disruption, assuming traditional businesses will disappear. This has created massive valuation gaps. I'm seeing industrial companies trading at 8 times earnings, REITs yielding 8%, energy infrastructure paying 10% dividends. These businesses aren't going away, they're essential to the economy. But fear has created prices that assume they'll vanish tomorrow. The combination of these three opportunities creates what I call a convergence window, a period when multiple favorable trends align. These windows are rare. I've seen perhaps 5 in my entire career. When they appear, investors who recognize them and act decisively can achieve returns that seem impossible in normal markets. But there's a catch. These windows don't last long, typically 18 to 36 months. Once the market recognizes the opportunity, prices adjust quickly. The same assets that offered exceptional value become fairly priced, then expensive. The cycle continues. We're probably 6 months into this current window, maybe 9. The easy money has been made by those who bought during the panic of late 2022. But the big money, the life-changing money, is still ahead for those who position themselves now. Here's how I think about portfolio construction in this environment. Forget the traditional 60-40 stock-bond allocation. That's fighting the last war. Instead, think in terms of 3 buckets. Bucket 1 is your opportunity capital, money positioned to benefit from the convergence window I described. This might be 40 to 60% of your portfolio, depending on your situation. Within this bucket, you want diversification across the 3 opportunities. Quality growth stocks trading at reasonable valuations, high-yield credit from solid companies, and traditional businesses trading at disruption discounts. Bucket 2 is your stable value holdings, assets that provide steady income and preserve purchasing power. This isn't traditional bonds which lose value when rates rise. Instead, think floating rate instruments, treasury bills rolling at current rates, and real assets like real estate or commodities that adjust with inflation. This might be 25% to 35% of your portfolio. Bucket 3 is your optionality positions, smaller bets on assets that could deliver outsized returns if specific scenarios play out. This could include precious metals if currency concerns grow, emerging market positions if the dollar weakens, or technology disruptors if you can identify the winners. Keep this to 10% to 15% of your portfolio. Enough to matter if you're right, not enough to hurt if you're wrong. The beauty of this approach is that it doesn't require perfection. You don't need to pick the exact bottom or identify the perfect stock. You just need to be generally right about the direction and magnitude of the shift. The convergence of opportunities provides multiple ways to win. Now I know what some of you are thinking. This sounds risky for someone my age. But consider the alternative. If you park your money in safe investments yielding 4%, while inflation runs at 3%, your real return is 1%. After taxes, you might be losing purchasing power. Over 10 years, that seemingly safe strategy guarantees you'll be poorer in real terms. The real risk isn't volatility, it's the permanent loss of purchasing power. And right now, the biggest risk I see is missing this convergence window, while clinging to strategies designed for a world that no longer exists. I learned this lesson personally in 1990. I was 44, had some capital saved, and was debating whether to play it safe or take advantage of the distressed debt opportunities I was seeing. Conventional wisdom said to be conservative, but I recognized the pattern. A credit crisis had created massive dislocations, and patient capital could earn exceptional returns. I chose to act, not recklessly, but decisively. That decision transformed my financial future and led to the founding of Oaktree. If I had listened to conventional wisdom, I'd have missed the opportunity that defined my career. You're facing a similar moment now. Not identical, history doesn't repeat exactly, but the pattern is unmistakable. Capital is rotating from overvalued to undervalued, from story stocks to cash flow generators, from zero yield to high yield, from speculation to fundamentals. This rotation creates dislocations, and dislocations create opportunities for those who recognize them. The question isn't whether this will happen. It's already happening. The question is whether you'll participate. I want to address the elephant in the room. The promise of turning $100,000 into $2 million in 2 years. Is this realistic? Under normal circumstances, absolutely not. Doubling your money annually requires either extraordinary luck or excessive risk, neither of which I recommend. But these aren't normal circumstances. We're in a convergence window. And during these windows, the combination of multiple expanding opportunities can create compound returns that seem impossible in hindsight. In 1982, if you had invested $100,000 across distressed bonds yielding 20%, beaten down industrial stocks, and early-stage technology companies, your portfolio could have grown to $400,000 by 1984. If you then rotated those gains into the emerging bull market in stocks and real estate, reaching $2 million by 1987 was achievable. Not guaranteed, but achievable. The same pattern played out from 2009 to 2011. Distressed debt, bank stocks, and real estate offered similar convergence opportunities. Investors who recognized the pattern and acted decisively saw life-changing returns. Today's opportunity might be even better because it's broader. It's not just one sector recovering from crisis. It's multiple sectors simultaneously offering exceptional value while most investors remain paralyzed by fear or anchored to old strategies. But let me be crystal clear about something. This isn't about speculation or leverage. Using borrowed money to chase returns is the fastest way to turn opportunity into disaster. This is about recognizing value, diversifying across opportunities, and having the patience to let the convergence play out. The biggest mistake I see investors over 50 make isn't being too aggressive, it's being too passive. They assume their wealth-building years are behind them. They shift to preservation mode just when their experience could be most valuable. They have capital, knowledge, and perspective, the 3 things needed to capitalize on major opportunities. But they don't act. Your age isn't a liability in this environment, it's an asset. You've seen cycles. You understand that extremes don't last. You can distinguish between temporary volatility and permanent loss. These insights matter more than youth or aggression. Moreover, you have something younger investors don't: the ability to be patient. You're not trying to get rich overnight to buy a house or start a family. You can wait for opportunities to ripen. You can hold through volatility. You can think in years, not quarters. This patience, combined with the current convergence window, creates a unique advantage. While younger investors chase momentum and older investors hide in cash, you can position yourself in the sweet spot, aggressive enough to capture opportunity, experienced enough to manage risk. The clock is ticking on this opportunity. Every month that passes, more investors recognize the shift. Valuations adjust, yields compress. The window gradually closes. By late 2026 or early 2027, I expect most of these opportunities will have played out. Prices will reflect new realities. The easy gains will be behind us. That's why the next 18 to 24 months matter so much. This is the period when positioning will determine outcomes, when the difference between acting and waiting could be measured in multiples of wealth, when your decision to embrace or avoid this convergence will echo through your retirement years. I can't make this decision for you. I don't know your specific circumstances, risk tolerance, or goals. But I can tell you this. In my 55 years of investing, I've learned that the biggest regrets come from opportunities not taken, not from volatility endured. The investors who built real wealth weren't the ones who avoided all risk. They were the ones who recognized when risk was mispriced, when fear created opportunity, when conventional wisdom was wrong, when convergence windows opened. We're in such a moment now. The question you need to answer is simple. Will you recognize it and act? Or will you look back in 5 years wondering what might have been? The choice is yours. But if you're waiting for certainty, you'll wait forever. Markets don't offer certainty, they offer odds. And right now, for investors over 50 with capital to deploy, the odds are the best I've seen in over a decade. This convergence won't last. Windows close, opportunities pass. But for those who act now, thoughtfully, deliberately, with proper diversification, the next 2 years could redefine what's possible for your financial future. I've shared what I'm seeing and how I'm thinking about it. The patterns are clear to me. The opportunities are real. The window is open. What you do with this information will determine whether you're among those who look back at 2025 as the year everything changed, or just another year that passed by while you waited for the perfect moment that never came. The perfect moment doesn't exist. But this moment, this convergence window we're in right now, might be as close as it gets.